Retire with More Money by Tan Uiboon. There is a specific challenge that faces personal finance writers in Singapore and Southeast Asia that their counterparts in the United States or United Kingdom do not face in quite the same way. The system they are writing about is genuinely unusual, genuinely complex, and genuinely misunderstood by the people who are most dependent on it. The Central Provident Fund, the CPF, is the mandatory social security savings scheme that sits at the center of virtually every Singaporean's retirement plan, whether they know it or not. It is one of the most sophisticated and, in international comparison, one of the most generous retirement systems in the world. And the majority of Singaporeans who have been contributing to it for decades do not fully understand how it works, what it will provide, or what they can do to make it work better for them. Tan Uiboon has spent years as a personal finance journalist at the Straits Times writing for exactly these people, Singaporeans who are diligent contributors to their CPF, who are vaguely aware that retirement is coming, but who have never fully engaged with the specific mechanics and opportunities of the system they are in. Retire with More Money is his attempt to close that gap. It is a book written for the Singapore context, with the CPF at its center, addressing the specific decisions that Singaporeans face on the path to retirement, and doing so with the clarity and accessibility of a journalist who has spent years translating financial complexity into language that ordinary people can act on. Let's walk through the full framework of the book, understanding both the CPF-specific guidance and the broader retirement principles that apply beyond the Singapore context. Part 1. Understanding the CPF, the foundation you are already building on. The CPF operates through three main accounts that serve distinct purposes. The Ordinary Account, or OA, receives the largest share of contributions for younger workers and can be used for housing, education, and investment in addition to retirement. The Special Account, or SA, is specifically designated for retirement and earns a higher guaranteed interest rate, currently 4%, compared to 2.5% on the Ordinary Account. The MediSave account funds healthcare expenses and MediShield life premiums. At 55, a fourth account, the Retirement Account, is created by drawing from the OA and SA to meet the full retirement sum, the Basic Retirement Sum, or the Enhanced Retirement Sum, depending on the member's accumulated balance and choices. The Retirement Account then forms the basis for CPF Life, the National Longevity Insurance Annuity Scheme that provides monthly payouts from age 65 for life. Tan Uiboon's most important message about this architecture is one that many CPF members have never fully internalized. The Special Account's 4% guaranteed interest rate is one of the best risk-free returns available anywhere in the financial system. Money in the SA earns 4%, compounded monthly, with absolute government backing, completely tax-free, with no risk of loss. The person who maximizes their SA balance through voluntary top-ups, the Retirement Sum Topping Up Scheme, is effectively buying a guaranteed 4% return on every dollar they contribute. In a world where guaranteed returns of this magnitude are extraordinarily rare, this is not a minor advantage. It is one of the most powerful wealth-building tools available to any Singaporean. He is emphatic about the opportunity cost of not using this tool. The person who has excess cash sitting in a bank savings account earning a fraction of a percent, while their CPF special account earns 4% guaranteed, is leaving money on the table in a very specific and avoidable way. The barrier is usually not awareness of the gap. Most Singaporeans vaguely know the CPF earns more than a bank account, but understanding of the specific mechanism for making voluntary top-ups and the specific limits and rules that govern them. Part 2. CPF Life, the annuity that solves the longevity problem. CPF Life is, in Tan Uiboon's framing, one of Singapore's most underappreciated financial assets, a mandatory longevity annuity that does something no private financial product can reliably do: guarantee a monthly income for life. However long that life turns out to be, at a cost determined by the pooling of longevity risk across the entire CPF membership. The core insight he wants readers to internalize is about longevity risk, the risk of outliving your money. This is, for most retirees, the most serious financial risk they face, and it is one that a fixed savings balance cannot fully address. A person with $300,000 saved for retirement who expects to draw it down over 20 years is exposed to the possibility that they live for 30 years, a possibility that the statistics suggest is quite real for a 65-year-old Singaporean today. CPF Life eliminates this risk entirely. Whatever happens to your longevity, your CPF Life payout continues unchanged. Tan Ooi Boon explains the 3 CPF Life plan options in practical terms. The standard plan provides higher monthly payouts but leaves a smaller bequest. The balance in the retirement account above the annuity premium is what passes to beneficiaries. The basic plan provides slightly lower payouts but retains more bequest potential because the full retirement account balance passes to beneficiaries if the member dies early. The escalating plan provides lower initial payouts that increase by 2% per year, which is valuable protection against inflation over a long retirement. He discusses the specific circumstances under which each option is most appropriate, noting that the escalating plan is underselected relative to its merits. Because the lower initial payout is psychologically unappealing even when the lifetime value is superior for long-lived retirees. The most actionable CPF Life guidance in the book is about deferring the start of payouts. CPF Life payouts can begin anytime from age 65 to 70. For every year of deferral, the monthly payout increases by approximately 6 to 7%. This is a guaranteed, inflation-proof enhancement to lifetime income that is available to every CPF member simply by choosing to delay. The person who defers from 65 to 70 can increase their monthly CPF Life payout by approximately 30 to 35%. For a payout that is intended to last a lifetime, this is an extraordinarily valuable trade. Part 3. The Supplementary Retirement Scheme. The tax advantage most people leave on the table. The Supplementary Retirement Scheme, or SRS, is the voluntary tax advantage savings account that Tan Ooi Boon identifies as one of the most underutilized retirement planning tools available to Singaporeans, particularly to those in higher income tax brackets. Contributions to the SRS are deductible from taxable income in the year they are made. The contribution limit for Singapore citizens and permanent residents is currently $15,300 per year. For a person in the 15% income tax bracket, a maximum SRS contribution produces immediate tax savings of approximately $2,300, a guaranteed 15% return on the invested amount in the year of contribution alone, before any investment return is earned. The tax treatment of SRS withdrawals is also favorable. Only 50% of withdrawals made from age 63 onward are subject to income tax. And if withdrawals are timed to low-income years in which the member has retired, reduced their income, or otherwise minimized their taxable position, the effective tax rate on SRS withdrawals may be very low or even zero. The combination of a full deduction on contribution and a 50% exemption on withdrawal, timed correctly, can produce a genuinely powerful tax arbitrage. Tan Ooi Boon walks through the investment options available within SRS accounts, which include stocks, bonds, unit trusts, fixed deposits, and annuities, and addresses the question of what to do with SRS money that is not invested and is simply sitting in the account earning the default interest rate of approximately 0.05%. His answer is direct. Invest it. An SRS account that earns the default rate is capturing the tax benefit of contributions while sacrificing virtually all investment return. The tax benefit is real and significant, but it does not compensate for decades of missed investment growth. Part 4. Investing for retirement in the Singapore context. Tan Ooi Boon's investment guidance is calibrated for the Singapore retail investor, a person who has access to the Singapore Exchange, Singapore-listed REITs, unit trusts through banks and financial advisors, and the growing range of robo-advisors and low-cost ETF platforms that have become available in Singapore over the past decade. He is consistently skeptical of high-cost investment products, the endowment plans and investment-linked insurance policies that are aggressively marketed by banks and insurance companies in Singapore and that carry charges that consume a significant portion of investment returns over time. His position is straightforward and supported by the global evidence. Most actively managed products, most of the time, underperform low-cost passive alternatives after fees. The Singapore investor who buys a unit trust with a 1.5% annual management fee is starting each year 1.5% behind a comparable index fund, and that gap compounded over decades, represents a substantial portion of retirement wealth. He gives significant attention to Singapore REITs, real estate investment trusts, as a component of a retirement-oriented portfolio. Singapore has one of the most developed REIT markets in Asia, with a wide range of listed REITs providing exposure to commercial, industrial, retail, and hospitality properties both in Singapore and internationally. Singapore REITs are required to distribute at least 90% of their taxable income to unit holders, which produces relatively high distribution yields, historically in the 4 to 6% range for many REITs. For the income-oriented retiree who needs regular cash flow, Singapore REITs offer a locally familiar and relatively liquid source of income that is different in character from bond income or CPF payouts. He is careful, however, to note the risks that REIT investors frequently underestimate. The sensitivity of REIT prices to interest rate changes. Higher interest rates reduce REIT valuations and increase the cost of the debt that most REITs carry. The property-specific risks of individual REITs and the concentration risk of allocating too large a portion of a retirement portfolio to a single asset class. REITs as a component of a diversified portfolio are a reasonable retirement income tool. REITs as the primary retirement savings vehicle are a significant concentration of risk that the distribution yield does not adequately compensate. Part 5. Housing and HDB in the retirement equation for most Singaporeans. The HDB flat, the public housing unit that approximately 80% of Singapore's resident population lives in, is their single largest asset. And for many of them, the question of how and whether to monetize that asset in retirement is one of the most consequential financial decisions they will make. Tan Ooi Boon explains the Housing Development Board's Silver Housing Bonus and Lease Buyback Scheme with the kind of clarity that their relative obscurity suggests they need. The Lease Buyback Scheme allows elderly HDB owners to sell a portion of their flat's remaining lease back to the HDB, receiving a cash payment and reduced monthly income in exchange. The practical effect is that the remaining lease term is shortened to 30 years in most cases, while the seller continues living in the flat and receives both the cash from the lease sale and a monthly income stream for the remainder of the retained lease period. For asset-rich, cash-poor retirees who own their HDB flat outright but have limited liquid savings, this scheme can meaningfully improve retirement income without requiring them to move. He is equally clear about the limitations and misconceptions. The lease buyback scheme only makes sense for people who do not need to leave the flat to their children and who do not need the full proceeds of an eventual sale. For families where the HDB flat is intended as a bequest to the next generation, using it for retirement income through the lease scheme will reduce or eliminate the inheritance. He also addresses the popular right-sizing strategy, selling a larger HDB flat or private property and purchasing a smaller unit, using the difference to fund retirement. The strategy can work well but requires careful calculation of the actual net proceeds after agent commissions, stamp duties, renovation costs for the new property, and the often underestimated emotional and logistical costs of moving in later life. The paper profit from right-sizing is frequently more attractive than the actual cash available after all costs are accounted for. Part 6. Retirement Income Planning. Putting the pieces together. The synthesis chapter of the book walks through the construction of a comprehensive retirement income plan from the multiple sources available to a typical Singaporean retiree. CPF life payouts, SRS withdrawals, investment portfolio income, CPF OA and SA interest, and potentially rental income or part-time work income. Tan Ooi Boon introduces a framework that will be familiar to readers of international retirement literature, the buckets approach, adapted for the Singapore context. Bucket 1 covers the first 3 to 5 years of retirement with highly liquid, low-risk assets, fixed deposits, Singapore savings bonds, and the CPF OA balance. Bucket 2 covers years 5 to 15 with moderate-risk income-producing assets, Singapore REITs, bond funds, and higher-yield fixed income. Bucket 3 covers the long term with equity exposure for growth, a broadly diversified equity portfolio, or index funds that will not be touched for the first decade of retirement. His most important message in this synthesis section is about sequencing. In a market downturn early in retirement, The order in which you draw from your various income sources matters enormously. Drawing from equity positions during a significant market decline, selling equities at depressed prices to fund living expenses, is one of the most damaging things a retiree can do to their long-term financial security. The bucket structure, with its guaranteed income from CPF Life and its cash buffer in Bucket 1, is specifically designed to prevent this, to ensure that during a market decline, the retiree is drawing only from sources that are not affected by equity prices. The critique, where Retire with More Money has limits the book's most significant limitation, is its geographic specificity. Every piece of CPF-specific, SRS-specific, and HDB-specific guidance in this book is irrelevant to any reader outside Singapore and Singapore-adjacent contexts. This is not a critique of the book. It is exactly what it intends to be, but it is important context for any reader who encounters it expecting universal retirement wisdom. Second, the investment guidance, while sound in its broad principles, is relatively light on the analytical framework that would allow a reader to apply the principles independently. The case for low-cost index investing is made, but the specific mechanics of building and maintaining a diversified portfolio, rebalancing, tax loss harvesting, the specific instruments available in Singapore, could be explored with more depth. Third, the book's treatment of healthcare costs in retirement is thinner than the topic deserves for a Singapore audience. While Singapore's healthcare system is more affordable and more universally accessible than the US system, the out-of-pocket costs of aging in Singapore, particularly for extended care needs, specialist treatment, and private hospital care, can be substantial and represent a genuine financial planning risk that the book addresses only briefly. Fourth, as with all books that include specific policy details, CPF contribution rates, SRS limits, CPF life payout calculations, the specific numbers will change over time as policy is updated. The frameworks are durable. The specific figures need to be verified against current CPF board and IRA's guidance. Final thoughts. Retire with More Money occupies a specific and valuable niche. It is a clear, accessible, Singapore-specific retirement planning guide written by someone who understands both the system and the readers who are trying to navigate it. Its greatest contribution is making the CPF framework genuinely complex and genuinely powerful, legible to ordinary people who have been contributing to it for decades without fully understanding what they have. The CPF, at its best, is one of the world's great retirement institutions, a mandatory savings system with competitive guaranteed returns, a sophisticated annuity scheme in CPF Life, and enough flexibility to accommodate the individual differences in Singaporean retirees' circumstances and goals. But an institution is only as valuable as the degree to which the people it serves understand how to use it. Tan Uiboon's book is a genuine contribution to that understanding. Know what you have. Understand the tools available to you. Make the decisions, the top-ups, the deferral, the SRS contributions that turn a good system into a great retirement outcome.